Let's get more now from Kai Lam, Chief Investment Officer at JCIC Asset Management. And Kai, thanks very much for joining us.
Thank you for having me.
What gives you the reason for optimism right now for the Canadian market?
I mean, look, with the war in Iran, we have elevated oil prices, given the risk to supply, and it is an uncertain situation where we don't know when that'll end. And so that's resulted in the high oil prices and a higher U.S. dollar against other major currencies. We also think that the gold price will have an elevated geopolitical risk premium that will persist and was there even before the war started. And in that context, the Canadian market, when we look at the energy market and the gold, it makes up basically about a third of the market. And so we think those will be resilient in this volatility.
And your thoughts on the impact of the release by the IAE of 400 million barrels of oil? Will that have an effect, do you think, on prices?
I mean, I think that'll have an effect on prices from where we saw it potentially, because just a couple days ago, it hit $118 a barrel, and so we can see that there can be involvement to kind of keep things down. But regardless, it'll still remain high for now, and that'll still have an impact on inflation.
And with Canada, we don't actually have an official Federal Reserve. We rely on private reserves, essentially, the oil companies. Does that have an impact here at all on anything that is unfolding?
I mean, obviously, it's a global price, and it'll have an impact on potential inflation in Canada. But we are a major energy producer, and so we've seen, other markets show greater sensitivity, like Europe and Asia, where they're bigger net importers of it, and so then that's something to watch out for. So we're relatively a bit more better positioned than those markets.
And I know, like Japan, a huge concern there. I think they import almost all of their oil. What kind of an effect could we see on Japan, places like Europe?
Yeah, I mean, the outlook for international markets including Europe and Japan was stronger actually before the war, and you're seeing that sensitivity in those markets since it started. And so that's something we have to watch for. We just don't know how long it'll last for, but we still see those market volatility there as an opportunity, because we're more of a buyer of dips, given that historically geopolitical risk doesn't really impair long-term market performance. It'll eventually fade, and so we'll just take advantage of those opportunities.
And we were seeing some rotation before all this. Is it still happening, and people still rotating out of tech?
Yeah, one of the challenges with the rotations that's been happening under the surface is we've seen significant rotations very quickly, and so it's been hard to kind of navigate or pin down which sectors to really favor or not favor with any real longevity. So for us, we've been more tactical on an individual stock basis, and just looking for opportunities on that way instead of specific sectors.
All right, and let's talk about some of the banks you're liking, or some of the stocks you're liking. FirstService is one of them. What's your draw there?
Yeah, so then this is actually a really recent purchase. If you can see, it has been weak performing. And that's because in 2025, they had some challenges with a couple of businesses, with the roofing and the renovation or the restoration business. But ultimately, most of the revenues are pretty visible and recurring within the property management and property services businesses. And we think 2026 will see an inflection point where those two areas that were negative growth are going to turn positive. The rest of the business, is still going to grow mid-single digits with acquisitions. And so you're getting this company at a trough valuations on the lower end of their historical range and well below historical averages. So we want to take advantage of this weakness.
And any potential headwinds for it?
I mean, look, we'll have to see how the economy goes in the U.S. We believe that the GDP growth was going to improve this year with the lower interest rates and the one big beautiful bill benefits. We'll see how long this Iran conflict will last and that impact on energy pricing. So we're still monitoring that.
All right, moving on. Hudbay Minerals, you just bought some of that recently. What makes it
Yeah,
shine?
yeah. Again, we also bought this recently on the pullback, taking advantage of that. We do like the copper commodity, given the long-term potential for for benefiting from electric vehicle expansion, as well as power generation expansion. And Hudbay itself is a low-cost producer of copper with gold byproducts, and they have strong growth over the next several years. It does trade at a discount to other large cap peers and trades below its net asset value. So we like it as well.
Now, and they just bought Arizona Sonoran. Any more opportunities do you see for them right now?
Yeah, so there will be other opportunities for them to take a look at, but really they don't need to at this point. They have enough projects on the go to deliver really strong growth to go 2030.
Okay, and last one to get to in the international markets, Schneider Electric.
Yeah, so we like Schneider Electric. We think that the mega trend towards energy efficiency is going to continue, and over 80% of their business is within energy management. We also like their exposure to data centers, in which in 2025, about 21% of the revenues came from data center revenue, but that should grow to almost 30% for 2026. And they're going to be a prime beneficiary of this data center growth.
And they really are kind of the epitome of picks and shovels, aren't they?
Yeah, yes, and within the hyperscalers, the hyperscalers are the biggest customers for them in the data centers, in which they provide they have like 95% exposure to those hyperscaler data centers.
Any concern with with a bit of the movement out of tech that some of the projects may get stalled or delayed?
I mean, look, I think the growth is really, really, really strong. And within the data centers, they're going to have to continue to build them out. I think that when it comes to AI development, I know there's been concerns about overspending, but really, ChatGPT was only introduced a few years ago. Um, you do have to have leadership established, and so then you have to spend right now, and it's not really a choice. And so they continue to benefit from it. But we do like having the companies that directly benefit from selling equipment into the cycle.
Okay, we'll wrap it up there. But Kai, thanks very much for joining us.
Great, thank you very much.
Kai Lam is Chief Investment Officer at JCIC Asset Management.